Good morning, everybody, and welcome to this topical webinar today on estate planning with Clive. If you have any questions, please do pop them in the Q&A function and we'll hopefully get to answer them at the end. If we do happen to run out of time, don't worry, I can download the questions and answer them via email. Thank you very much, everybody. Over to you, Clive.
Thanks, Sarah. Good morning, everyone. Clive Howarth, Associate Director here at ETC, and welcome to today's webinar on estate planning. Hopefully some topical stuff that will be of interest to you and your clients. So if we just go on to what we're going to cover today, I'll just do a brief introduction as to why we're talking about this, looking at some of the things that are of interest: normal expenditure out of income, the residence nil rate band, which is still with us, using multiple trusts, using the RISAFE principle, which some of you may be familiar with, some not, can be quite useful in IHT planning. We'll look briefly at family investment companies and how they can be used to save inheritance tax. Look at the budget changes to business relief and agricultural property relief, pensions and IHT, and finally a little bit about EBTs and IHT. So why is estate planning important? Well, between April 24 and October 24, IHT receipts were 5 billion, which is up £500 million on the same period for the previous year. Obviously, rising house prices are a major factor in this, and also, of course, the fact that the IHT no rate band has been frozen at 325,000 since 2009 means that more and more estates are being brought into inheritance tax. If it had been linked to the RPI, the nil rate band would be well over 450 grand by now. So normal expenditure out of income, often overlooked, but can be important because if you do qualify for normal expenditure out of income, it's immediately out of the estate for IHT. There's no 7-year period or anything like that, but the qualifying conditions are fairly stringent. The gift must be made as part of normal expenditure of the donor. HMRC's interpretation is that the gift should form part of a regular pattern of payments. So examples would be Christmas and birthday gifts, annual family holidays, insurance policy premiums, payments towards education, healthcare, etc. So those are what HMRC would say, yeah, we'll accept those as being normal. The donor must, of course, retain sufficient income to maintain his or her standard of living. So whether it's made out of income is a subjective test. It must be made out of income and not capital. And HMRC do look at this quite carefully in some cases. Income from earlier years doesn't retain its character as income indefinitely. In HMRC's view, income can become capital after 2 years. So you can't say in 1 year, yes, I'm giving this, it's out of surplus income from my previous 3 years surplus income. HMRC won't accept that. The residence nil rate band, we'll just cover this briefly. It's been with us now since April 17 and is now at the maximum of 175,000 per individual. Some key points to look at. Only available in full if the estate is 2 million or less, and no residence nil rate band at all if the estate is above 2.35 million. This is because, of course, the residence nil rate band is abated by £1 for every £2 over the 2 million. Note that these limits are before any relief such as business relief or agricultural property relief. Husband and wife may each have an estate less than 2 million, but on second death, all the residence nil rate band can be lost. For example, 1.5 million estate each, but on second death, £3 million estate, no residence, no rate band. So some planning here is that you could consider the main residence being owned as tenants in common and leaving property to children on the first death. There are downsizing rules. They are quite complex, and I think here it's just important that you can keep records and trace the flow of funds to prove that the money is effectively related to the main residence. Now we're going to move on to the using multiple trusts, which is the RISAFE principle. Apologies here for the rather wordy slides to come. The RISAFE principle relates to RISAFE Trustee Company versus Inland Revenue Commissioners, going back to 2003, where some very clever lawyers came up with a series of trusts created on consecutive days. Their theory was that by establishing a series of smaller trusts rather than just one trust, they can reduce the impact of the 10-yearly periodic charge and exit charge and benefit from a nil rate band for each of the individual trusts. HMRC obviously didn't like that and said, hang on, making all settlements for associated operations, and that therefore there was one settlement for tax purposes effectively. Excuse me. After an initial successful hearing, the High Court and the Court of Appeal basically ruled against HMRC and said that disposition had its ordinary meaning and was not to be extended to include a disposition by associated operations. The judge in that case, well, you can read that if you want to, but he said on your bike, HMRC, basically you can't just import that there's one trust when there's single trusts and they're each basically stand on their own. And if you look at the actual legislation, which is section 62 of IHTA 1984, a related settlement, it does say the settler has got to be the same in each case and the trust commenced on the same day. So effectively the judge is saying that's what the legislation says and that's how it stands. So HMRC lost the case, so it is possible to set up trusts on different days and they can each basically qualify for more or less the 325 exemption. As a belt and braces approach, we think each trust should probably have different beneficiaries, maybe different shares in them or whatever, but just to be slightly different, just as a belt and braces basically. So HMRC, having lost the case, it was reviewed by the GAR panel, the General Anti-Abuse Rule panel, and they said this: do the tax arrangements accord with established practice, and has HMRC indicated its acceptance of this practice? The practice was litigated. In the case we've just mentioned, HMRC lost the case and have chosen not to change the legislation. Must be taken to accept the practice. So as things stand, it's perfectly okay to set up trusts on different days using this RISAFE principle. So what are the tax savings that can be gained by using RISAFE? Literally depends on how many trusts you want to set up and the value of the assets at inception. The more trusts you use, potentially the more tax you're going to save. Because the rules work that if you're going to use multiple trusts, you're going to put things of low value into each trust on separate days. So on the first trust, you would have a 325 exemption. On the second trust, if it was only £10 in value, you'd have 325 less £10, etc. So the potential saving, roughly is going to be 325 at 6%, 19.5 grand. If you're doing that over 10 trusts, a saving at the 10-year charge date of 195,000. So, can be very useful. Mention family investment companies, so let's have a look at those. More popular now than trusts, and I think that's because most clients are familiar with how limited companies work. They know they've got shareholders, they've got directors, they've got a company that files accounts, etc. Whereas trusts have this rather mystique about them sometimes, with a trustee and trustees and beneficiaries and remainder men and all the rest of it. So a little bit simpler, very easy to set up, and you can have an unlimited company. If you want complete confidentiality, an unlimited company doesn't have to file accounts at company's house, so that can be useful. A FIC will usually have more flexibility to adapt to changing circumstances. So, a family's circumstances and needs may change, and a family investment company can well adapt to any changing circumstances. And if it's no longer fit for purpose, or children are old enough to look after themselves, or you want to just unwind and give them the money, very easy to unwind, more so than probably a trust and all the legal stuff you have to go through there. Financing the FIC. Usually parents will lend money to the FIC interest free. Loans really never intended to be repaid, but obviously if the circumstances change, they can be if required. Obviously, when I mentioned trust previously, once you put money into a trust, that's it, it's gone forever. So that gives you some flexibility there. But obviously the loan is then still part of the parent's estate. If we look at the typical share structure of a FIC. So parents will have the voting shares, the ordinary shares, so they're in full control of the company, but the capital rights attaching to those shares will usually be restricted to the par value. On top of that, we'll have growth shares issued. They will participate in the future growth in value of the company. Because it's the future growth, the initial value will usually be low, or par value, because obviously at inception the company may have £2 million that it's got in its bank account, but it owes that £2 million back to the parents as shareholders. So the cash held, so with zero balance sheet, as I've just mentioned, various classes of growth shares can be issued, and depending on basically the structure of the family, children, grandchildren, and whether you want to use trusts, etc. Growth shares, if you've got adult children, they can be issued directly to adult children, and trusts in particular can be useful to hold growth shares, again using the RICE principle, assuming growth shares of low value. There's little impact on the availability of the IHT nil rate band, and growth shares, as I've said, can be gifted outright, or we can use multiple trusts using RICE, so that can be quite useful. So other uses of a FIC, obviously on inception the parents are owed the money back. They can consider assigning part or all of their loan accounts over time. Parents still control the company, of course, so they are in control of when the assigned loan is repaid, if they want to repay it at all. So it's a pet, and it's subject to the usual 7-year rule, so it can be outside the parents' estates after 7 years. So it's a good way of giving away cash without actually doing so, because you might assign a loan of £100,000, so it starts the clock running on the pet, but you've actually not actually given your children any money at all. You've just given them a loan that you are in charge of when they get their hands on it. Interest can be paid on the signed loans if required, where shares are held by adult children. Common strategy is to accumulate income within the trusts, so distribute when over 18, commonly used to fund school and university fees. So here, if the trust received dividend income, for example, the trust would obviously pay tax on that, but it becomes a tax credit, and when that's paid out to the children, that can be reclaimed if they've got no other income, or it's got a 45% tax credit, so they'll be able to claim at least some of it back. With all this planning, HMRC some time ago thought, hang on, what's going on? Let's have a look at this. So they set up a family investment company investigations unit in April 19 to look at whether tax avoidance was going on with FIX. And after 2 years of scratching their heads and doing a bit of investigating, it was disbanded, and they said there's no evidence of any tax avoidance or non-compliance. So pretty plain vanilla from HMRC's point of view. Moving on now to business relief and agricultural property relief and the changes to those announced in the budget. Unless you've been off grid for the last couple of months, you realise that things have changed a bit. From April 2026, only the first million of combined agricultural property relief and business relief will continue to receive 100% relief. Relief will only be given at 50% over that cap. AIM shares from April 26 only qualify for the 50% relief, and they don't get the £1 million allowance. Any unused allowances cannot be transferred to the surviving spouse. And what about trusts? Well, the trust has been established prior to budget day. They have their own £1 million limit. Trusts created after 30th of October will have a combined £1 million limit. So, what can we do in the meantime? So we've got a window of opportunity now between up to April 26 to take advantage of the 100% business relief and APR that still applies. So consider outright gifts of shares, in family trading companies to adult children. No IHT and no CGT, because holdover would of course apply. Consider setting up trusts. No limit on the value of shares that can be gifted into trusts if they qualify for business relief or agricultural property relief. Of course, any gifts into trust are eligible for CGT holdover relief. The next bombshell introduced by our darling Chancellor, Rachel. From April 27, as things stand, pensions will be subject to IHT. And this will have a major change on financial planning for many clients. Historically, IFAs will tell their clients, leave your pension alone, spend everything else, and your pension's exempt from IHT. Obviously, that's now completely about face. So, as things stand, you'll be advising clients to spend your pension first and leave everything else, because at least that's only taxed once. There's a potential there is a double tax charge as things stand on pensions. First of all, IHT is payable at 40% on whatever's in the pension fund. And then when it's distributed to beneficiaries, that's also subject to income tax. So what you can end up with, out of a 1 million pension pot, if you do the maths, you could potentially end up with only £330,000 after paying the IHT and 45% income tax. All pretty horrendous. So what can we do? Well, many high net worth individuals will consider leaving the UK for a more tax-friendly jurisdiction, and we are already getting inquiries in that direction, not just on pensions but for generally. Used to be popular to export your pension to a qualifying recognised overseas pension scheme. Now there's a 25% tax charge if you do export your pension. That was introduced on budget day as a response to the IHT on pensions. So look at double tax treaties to see which jurisdictions offer more favourable tax treatment from the UK. And I think it's important that you take professional advice from an international pensions expert to look at what your options are and how best to navigate through these muddy waters. We have contacts with international pensions experts. Can be quite useful. There is a solution, not from us, I would add, but thought-provoking, so we'll go through it. Fred's a pension pot of 2 million. Goes to a tax jurisdiction which exempts his UK pension from tax in that country. I think in the thing I read it was Dubai, I think. So he draws £400,000 a year from his pension. He only needs £100,000 to live off, so £300,000 a year is surplus income, and he gifts that to his son as normal expenditure out of income. So over time, obviously, his pension fund dissipates and reduces to nil, and no IHT. Hooray? Well, possibly not. Would HMRC look at GAR and say, well, the only reason you've done this is to avoid IHT, so we don't think it's normal expenditure out of income anyway? And, well, look at the word normal. Is it normal that you've suddenly started giving £300,000 a year to your son? Probably not. So if you have a client who wants to go down that route, then by all means do so. But it's not on our. I wouldn't advise it. I wouldn't say that that's going to stand up to any sort of scrutiny from HMRC. Finally, some of you may be familiar with EBTs and all the loan charge legislation that's come in, and the heartache and anguish that's caused to many clients going back many years. Well, I think they were originally set up in the 80s, but 90s and 2000s, going back many, many years, trust was set up. Council's opinion, do this, it's great. You can put as much as you want into this trust and then take it out again by way of a loan. No income tax, no problems, all the rest of it, which obviously it didn't do. So subsequently, with the loan charge legislation, many clients have settled with HMRC and paid income tax and even national insurance on the loans that they've had. So that you would have thought would have been the end of it. But there's nothing in the trusts apart from these loans. But HMRC are saying Yes, but although it's a loan, there's an IHT due on the value of the loan and on the face value. And there's also an exit charge when that loan is written off. Bit odd, because HMRC here are ignoring some of their own published guidance. In particular, when they were looking at the loan charge and trying to charge income tax on people, they were saying the loans are no different to income and are therefore subject to income tax and taxable. So they're basically saying, yes, you've had a loan, but it's not a loan, it's income. But then on the other hand, they're saying, yeah, we know it's income, we've taxed it as income, but it's also a loan. So we're having an IHT on the value of that loan, which seems bizarre, but is unfortunately HMRC's view at the minute. And on the exit charge, so many cases we've dealt with, so you've settled on the £200,000 that you've had as loan, you paid income tax on it, then the loan's written off in 2023 or whenever. That is also under Part 7A ITEPA potentially chargeable to income tax, but it isn't charged to income tax because of a tax relieving provision to avoid you obviously getting taxed twice on the same figure. So it is chargeable to income tax, but you don't pay tax on it because you've already paid tax. So there is a specific provision that says there isn't any IHT on an exit charge when it's subject to income tax. And HMRC is saying, yeah, but it's subject to income tax when you're paying it out. So the fact that you've paid tax on it previously, and although it's taxable now, HMRC are saying, yeah, sorry, but it's still not taxed, it's still not income, and we have an IHT on it. So that's where we are. Fortunately, there's a fresh review of the loan charge legislation, which is underway. When it's going to be concluded, I don't know, many months' time. Hopefully the IHT position will be clarified. We've made representations as a firm on both these points, because it's clearly unfair that something can be taxed as income and then also subject to IHT. So it's a sort of double penalty. But we'll see how that goes. So with a couple of minutes to spare, that's about all from me. So thank you. My name's Clive, as you should know. Those are my contact details. If something you want to discuss over email, just feel free to email me on this email address. And I'll hand you back to Sarah if we've got time for a question or two.
Thanks, Clive. Yes, I've got a couple of questions that have come in. On fix, can miners be shareholders? If so, can they draw dividends?
Miners can be shareholders, but if the shareholders in their own right, then the income will be taxed on the parents under the settlements legislation.
Our next question is, can fixed setup costs be put through the associated trading company and not the FIC? And would any costs be tax allowable?
No, they're not for the purposes of the trade, so no, they wouldn't be.
Okay, and another question that's come in, where do you get valuations from for the 10-year calculations for properties if you do not have any history?
Yeah, so I think I'm going to raise.
Where do you get the valuations from? Well, you've got to either, we're talking property, you say?
Yes, for properties if you do not have any history, yes, properties.
Yeah, so you'd have to get a professional valuation from a valuer.
Okay, and then I've got a question on growth shares. Any problems on valuations with HMRC?
They don't tend to be. They can be, but what we tend to do is make sure that the growth shares initially at least don't have any rights to dividends. So then any valuation can only be on the hope value, if you like, of what the FIC does. And it's difficult to argue in any sort of financial climate what you can't guarantee that the company is going to make a load of money, so you can usually value it at quite a low figure, and usually because the non-voting and all the rest of it, you apply minority discounts. So whatever value you arrive at, you discount it by probably at least 75%. So you end up with quite a nominal value.
And then finally, on the 7-year clock on pets, does it apply to any gift from day one?
Well, it does, but what you've got to bear in mind is that before the taper relief applies on the after 3 years, you've got to get up to £325,000. So the first £325,000 of gifts effectively goes against your nil rate band within the first 7 years. So it's only above that effectively taper relief begins to apply.
Thank you very much, Clive. And we have our next webinar on the 23rd of January, which we're doing on stamp duty land tax. If you follow us on Eventbrite, you'll be able to register for free there. Thank you, everybody. And thanks once again, Clive.
Thank you. Thanks, everybody.